Thank you for those who were in the room already. We have about a minute to 2 minutes before the session officially starts. I want to give others the opportunity to be able to join us before we begin. Okay, I have 2 o'clock, so we can get started. Thank you very much for those who are in attendance. From the looks of it, it looks like it's all family at the moment. I guess others will be joining, but if it turns out that that's all we have, heck, we could have this conversation at home. But we're going to go ahead and get started. I want to thank everybody who is there. I know so far where everyone is from, so I won't ask you to put that in the chat. I am filling in for someone who has far more banking experience than I do, but I have put together the presentation as we called for to talk about understanding the benefits of working with Black-owned banks. And I think we'll all get something out of this. So we're going to get ready to get started. And if you bear with me 1 second, let's go. So we all know what has happened over the last 100 so many years as far as banking in the Black communities have been concerned. We've had a lot of racism that we've had to deal with as far as banking is concerned. We're going to touch on that a little bit. We know that racial bias has been kind of out there also in terms of how we have been portrayed as not credit worthy people. Therefore, they don't feel that there is much of a market for us. And we're going to talk about that a little bit too. So in this presentation, what we're going to look at is the importance of Black-led banks, the role that they play in supporting the Black community. I'm going to touch a little bit on how COVID-19 has impacted the Black community, and we'll talk about the future of the industry as well. So the importance of having Black-owned banks, as it says on the slide here, excuse me, is that the lack of access to financial institutions It's primarily due to an outdated mindset. Again, that characterization that we are not credit worthy people. We need Black owned banks to be able to step in because they know us better than most other folk know us. And they know just what we are and how we are. And they know how to work with our people. We're not any less creditworthy than anyone else. We pay our bills just like everyone else. But there's a lot of things going on as far as the Black narrative is concerned that sort of gets in the way, and it causes people to think that we're just way at the bottom of the barrel here. We want to disprove that. So if we look right now across the United States, we see, if you look at the deeper shaded areas, that's where there's a higher concentration of Black folks living. If we look there, we see that for the most part on the eastern seaboard is where we have most Black owned banks. We've got one out in California. We have one up near the Chicago and the Detroit area because we have high concentrations of African Americans who live in those communities. But as far as the rest of the United States is concerned, we see that there aren't that many Black owned banks. In fact, there aren't any Black owned banks. There is one, and we'll talk about that a little later. But here is what the problem is. Right now, Black owned banks are dwindling. We're losing them. They're going out of business. The heyday was in the early 1900s, and that was when we had Jim Crow laws. So we had our own banks, especially in places like Greenwood and Tulsa, Oklahoma. We had our own banks because they catered directly to us because we had nowhere else to go. We also had a resurgence back in the 50s and the 60s, right around the time that civil rights was being pushed. And then we had a fall off somewhere in the 80s. It actually came back in the 90s, and it has been shrinking ever since. We're right now at, according to the graph here, which shows 2020, about 22 Black-owned banks in the United States. And actually, according to some research, that number has dropped down to 18. So we want to look at, well, what is the cause of that, and why is it that we can't get enough Black-owned banks, and what's the impact of not having enough Black-owned banks? Let's talk about the most recent incident and situation, and that is COVID-19. What the data shows is that most of the small businesses in Black and brown communities had an unequal access to COVID relief funds. Okay, we did not get them as quickly as other communities. If you look at the graphs here, the one on the top left, which shows the amount of loan approvals for the pandemic loans. Now, for those who may not be familiar with it, the pandemic loans were loans that the federal government made to all businesses. And on top of that, the caveat is that if you use 85% for payroll, that the loan for that would be forgiven. So it was a way that the United States was looking at how do we keep money in the pockets of America so that they can continue to live. If you look at the chart on the blue side, it's majority white residential zip codes. The red side, majority Black residential zip codes. And that's based on percentage, not population. So yeah, I know that there are more whites in this country than Black folks, but this is based on percentage. If you notice that towards the very bottom in week 19, it is showing that we had a lot of African Americans who finally got their money. So imagine what they did for the 18 weeks prior to that. We also see on a cumulative basis that by week 8, 83% of white homes or white businesses had 83% of 83% of their loans that went to white businesses. We hadn't even scratched 50% by that same time mark. So it took longer for Black-owned businesses to get those PPP loans. If we look at it from businesses that are employers versus businesses that are sole proprietors, it took Black businesses that had payroll about 31 days in order to get their approval. It took small business, individual business owners who did not have employees even longer, roughly about 62 weeks, more than 2 months before they saw any monies that were coming in. And the majority of the money, if you look at the chart on the far bottom, the majority of the money that we were able to get actually came in from online lending companies, not as much from traditional large banks. So if we remember during that pandemic, most of the large banks gobbled up a lot of the money right at the very beginning. Black-owned banks were not necessarily in the picture as strongly, primarily because in part, their numbers are shrinking. So the question is, well, how did we get here? How did we get to this space, this place in time where Black-owned banks are in such a financial situation? There's a couple of things, and there are two major things in history that happened that caused a lot of this. But before we get into that, what I want to do is just take a moment to give everybody, let's bring everybody up to speed on how banks make their money so that we understand going forward what's going to happen here. So the question is that how banks make their money, all right, is what they call an interest rate spread. Banks pay you interest when you put money into a savings account. They charge interest for any loans that they use that money for. And the difference is what they keep. So if they had, if they paid you 2% on your savings account, they may be charging 15% or 9%, 10%, whatever the case may be, on a loan that they make to a business or to an individual. They keep the difference between that, say roughly about 5-6%. They keep that for themselves. And that's the basic way that banks make money. There's also what they call a banking multiplier effect. And the multiplier effect works like this. Let's say you deposit $100 in the bank. The bank is required to keep 10% or $10 of every $100 you deposit, okay? But the bank has the ability to lend out the other 90%, or in this example, $90. Now, banks usually lend money to other banking clients, not to people who just walk in off the street. So that means that banking client already has checking account, savings account with that particular bank. So they're taking 90% of the money they received from a savings account, they're lending it out to someone else who's putting that money into a savings or checking account, and they'll take that and they'll leave 10% of that in reserve, and they'll lend out 90% of that. And they'll keep that process going for some time. So from that $100, that bank has the opportunity to lend it out or some portion of it out multiple times, and at the same time, charge interest on that money. Now, because of the amount of interest that they're paying you, they're not only getting the difference from the first loan, but they're getting difference from every loan after that off of your $100. So that is how banks tend to make most money. And this is how it looks and works for you. You put your money in a savings account, you give it to the bank lends that money out to other people or other businesses. They pay interest on that money and they start paying back those loans. So when they start paying back those loans, that puts money back into the bank that they can lend out to someone else. You get paid interest, but the interest rate is usually not as large as what the banks are charging other people. Now, you have the ability at any given time to take your money out of the bank. Okay. And if you do that, they have to keep money on reserve so that they can make sure that they can pay you whatever you have in your account. But what banks like to do is they want to encourage you to keep your money in the account. So they have what they call certificates of deposits or CDs. Usually that pays a higher rate of interest, but here's the catch is that you have to agree. It's normally a contracted arrangement where you agree that you're going to leave that money on deposit in that bank for a certain amount of time. That could be anywhere from 3 months, that could be 3 years, that might be 10 years, okay? But whatever it is, the longer you're willing to lock that money up with that bank, a higher interest rate they're willing to pay you on it because they know how much money due to the multiplier effect they're going to be able to make. So you'll be able to get more money from a CD than you can from a savings account because of the fact that you're giving the bank that authorization to continue to use your money over and over and over again. Now, that's not a bad arrangement. There's also different types of CDs. So you have some that lock in for a long period of time. You have some that will be for a shorter period of time. You also have some because interest rates tend to fluctuate. Sometimes they'll go up, sometimes they'll go down. You can lock in a higher interest rate, and if interest rates go down, you can sit with your higher interest rate CD and continue to make that money. If it happens the other way around, where interest rates are going up and you're able to get a higher rate than what you may have, you have what they call a bump up CD. All right. All of those are considered organic, means this is money that came into the bank that the bank is able to use without having to make a lot of effort. Okay. The other one you have is brokered CDs. Now, these are not necessarily organic. This is where a bank can take their certificates of deposit. They can publicize and advertise anywhere in the country, and they can get people who are saying, well, based on the rate that you're willing to pay me, I'm willing to give you money that you can lock into a CD, that I'll be able to earn interest on, even though I'm not a customer of that bank. That is what they call an inorganic deposit, because you're not necessarily a customer of that bank. This is not a natural thing for them. But these are ways that they have the ability to bring in deposits. The key thing and the important thing is that they bring in deposits. Those deposits are what gives them the baseline to be able to make loans to people who have banking relationships with them. So in essence, the way banks make their money is they have deposits that come in, interest from those people who borrow, and fees that they charge for certain services. Money that leaves the bank, of course, is interest that they pay you on your savings account or on your CDs. The money that goes out to businesses for loans, but eventually will be paid back. The only money that they tend to lose on, if you want to call it that, excuse me, is the cost of doing business. And that covers salaries of the employees, taxes, and other costs that they have to pay, costs for the building maintenance and things of that sort. And then, of course, there's that percent that they're required to keep on reserve so that they can pay out to people who come to get money out of the bank. So that seems like a pretty straightforward and simple process to follow. Why do we not have a lot of Black-owned banks that will be able to do that? Part of the reason for that is there's a lot of distrust in the African-American community of banks, okay? And there's two major reasons for that, and I want to jump through that. The first reason is the Friedman Savings Bank. So this was a bank that was set up because, keep in mind, prior to the Civil War, most African Americans were enslaved. You had no money because you didn't get paid, okay? But when the Civil War broke out and when Abraham Lincoln signed the Emancipation Proclamation, there were many black men who left to go and fight on the side of the Union. At that time, they got paid to be in the Army. So, what are they going to do with their pay? Where are they going to deposit their money? Early on, they were just squandering it because they didn't know much about it. They were holding it in their pocket. They would spend it on whatever they find. Some cases, they may have been cheated out of it. So, the Freedmen's Bank came about after the Civil War ended as a place to get the African American community started with banking. The problem with that is that while it was a great idea, you had a lot of white, let's say racists, who undermined the entire process. They undermined the Freedmen's Bureau, which is how a lot of public schools were started. And then they also undermined the Freedmen's Bank. And in doing so, as you can see in this picture, what they're talking about here is that they're portraying black folk, the Negro, as idle, lazy, shiftless, whatever. It's amazing that we didn't get portrayed as being lazy until after we stopped working for free. And then all of a sudden, they took a different look at us. But in here, Abraham Lincoln had already passed. The Freedmen's Bank came about in March of 1965. Abraham Lincoln was assassinated in April of 1965, and Andrew Johnson took over. He was not a friend of the black community, and he had a completely different way of looking at things. The whole 40 acres and a mule process that came through under Lincoln, but was not finalized, he scrapped it. So anything that would cause African Americans to be on equal footing with white America, he did his best to make sure that he did away with it. So you had those white supremacists that supported Andrew Johnson for that reason, and you had Congress that was the radical Republicans at the time, much different than today's Republicans, but they were doing everything they could in order to pass legislation to put former slaves, African Americans, on equal footing and be just as American or considered just as American as anyone else. That was the whole reason why they impeached Andrew Johnson, but they could not remove him because he kept vetoing everything they tried to do. So when they came about with the Freedmen's Bank, and that became an issue, and they did everything they could, unfortunately, in 1874, that's 9 years after it started, they managed to shut down the bank. And the problem is that those black people who had deposited money in that bank lost their deposits. Most of them never recovered those deposits. So that started distrust with banks in the black community. The second major thing in history that caused problems, after the Great Depression, under Franklin Delano Roosevelt, you had the Homeowners Loan Corporation that was created. Now, that organization was an agency of the federal government, and their job was to back up any mortgages that were out there. Keep in mind that during the Depression, there were a lot of people that were losing their homes due to the fact that banks just called in their mortgage for no particular reason, but the banks needed the money. So you had people that had their homes foreclosed on because they didn't have whatever the balance of the mortgage was that they could just write a check and pay the bank with. So in order to keep that from happening, Roosevelt came up with this program so that the United States government would be a backstop, if you will, so that the banks don't have to go and foreclose on homeowners who had mortgages. Now, when they put this together, they had 4 different quality categories. It was just interesting how they determine the quality of each category. So the first category, or grade A mortgages, were those mortgages that were in what they called green spots. Okay, they were hot spots. They were places that were not fully built up yet, presented a lot of construction opportunities, new jobs, greater economy opportunities. So they were willing to lend money so that they can build these areas up. One of the things that they say is that these loans were what they called homogeneous. Basically, it was code word for whites only. Okay. So if you were in a whites only community, your mortgages were considered first grade. The second area, the blue area, were communities that were fully built, so there were no construction opportunities, but there were a lot of home projects that could be undertaken. There were a lot of mortgage refinancing opportunities that could be taken. And those, again, were in predominantly white communities. So those were the two best grades. The next one, grade C, were what they coded as yellow. And that was due to the fact that there was an infiltration of lower grade population, probably underclass whites, poor whites, and immigrants that were coming into those communities. So they didn't consider those to be anything of quality like the grade A and the grade B, the green and blue loans. Okay. The last one was the red area. And what was really stuck out about that is that those were what they characterize as places where the undesirable population or infiltration of that undesirable population lived. You can only imagine who they characterize within that space. So those were predominantly African Americans, so that if a bank wanted to lend money to an African American in an African American community, the chances are the federal government was saying, you're on your own. And if you don't get paid back, not our problem. And this is what they called redlining. So if you look on the chart, you'll see all of the areas on this particular map were the predominantly Black or African American communities. Those are the ones where it was hard for the homeowners to get a mortgage. It was difficult for the homeowners to get home improvement loans. And so you started to see deterioration in those communities. People not able to hold on to homes, people not able to fix up their homes because they lacked the money. Well, what happened is that those areas started to blight. You started seeing a lot of vacant homes. You started to see things torn down, so you had a lot of vacant lots. A lot of that still looks the same, even today, in a lot of our inner city communities. And the reason for that was due to redlining. Now, keep in mind, this organization was put in place in 1937. In 1977, Jimmy Carter signed legislation creating the Community Reinvestment Act. So for 40 years, this practice was in place. If you lived in a predominantly African American community, it was much more difficult for you to get a loan for your home or to fix up your home than if you lived in a white community. And they turn around and they look at us and say, those people live in shambles, they tear up their communities, et cetera, et cetera. And oftentimes we began to believe that without realizing that the problem was we didn't have the opportunities to get the loans that they gave in white communities. The Community Reinvestment Act was good on paper, but in practice, no one monitored the program. You may have a bank examiner that goes into a bank. Maybe they ask a question about, are you complying with the Community Reinvestment Act? And the bank would simply say, we haven't had anybody from those communities come in to ask for a loan. Well, if you go to a bank and you walk in and you get to the banker's desk and inquire about a loan, and the banker starts talking to you in a way to steer you away or to discourage you from taking out the loan with that bank, that never shows up on paper. So nobody knew that people were being turned away, right? And the problem is that even though it was there on paper, it never materialized. It was never realized. It just sat there. It was about as good as the paper that it was written on. And the result is that you had a lot of our communities now, because banks started shutting down, moving out of African-American communities. I know in the city where I grew up, many of the banks moved out of the community, donated the bank building that they had to some nonprofit organization so they can get a tax write-off, but they moved away from the area. So, excuse me, we had no one that we can go into to make bank deposits, to get checking accounts, to get loans. So the result was, for many people who live in these communities, and you can probably go through a lot of those communities even today, and you'll see that they have check cashing places because there are no banks for them to be able to deposit their check or to walk in and cash their check. You'll see that they have payday loans because there are no banks for them to be able to go to in order to get a loan. For people that were looking at doing home improvements, people that were looking at renovating houses, all of a sudden, because of the way we were characterized as not being credit worthy, you had low credit scores. So that meant that you could not get a mortgage or refinance a mortgage in most places because they didn't deem you to be qualified. Now, here's the interesting part. If you had good credit, and there were a lot of African Americans who had good credit, a lot of these subprime lenders started going into Black and brown communities, and they started issuing loans, but they were giving them subprime loans, even though their credit score would suggest that they should be able to get one of those grade A loans. And the problem is that most African American homeowners were completely unaware. They didn't shop around to find out if they were getting the best mortgage rate. In some cases, they just believed the mortgage lender who came to their door that this is the best rate that you can get or that we can get for you. And they signed off on these mortgages when they should have had mortgages with much lower credits, much lower interest rates. So they were being overcharged on the interest rate without necessarily realizing it. It's a crime that was happening, and nobody knew that there was a victim because the victim didn't even know that they were victims. And this is where our communities are today. So these are the things that we have to look at, and we have to figure out, how do we stop the bleeding? There's a couple of things that can be done. If we look at how do we develop a plan to change this and set course in a new direction. I like this expression. Black-owned and Black-led banks need to increase the number of checking and savings accounts, business lines of credits, mortgages, and other loans to significantly move the needle. Well, how's that going to happen? The way that's going to happen is we start organizing people and we start organizing our money. What do we do with that? For one, we can take a look at this statistic. There's about 21 Black-owned banks, according to this. Total assets in the bank, close to $5 billion. That's only less than 0.5% of a percentage point of what Black America's buying power is. We have buying power of $1.1 trillion. I think it's now up to $1.3 trillion. Yet Black-owned banks only have somewhere in the neighborhood of assets of close to $5 billion. That is a huge gap. Again, less than 1% of all the money that comes through Black America winds up in Black-owned banks. I'll repeat that. Less than 1% of the money that flows through Black America, that is money you get from your paychecks, money that you get from other sources, less than 1% finds its way to Black-owned banks. That is a major problem. I'm a big fan of, if it can't be measured, it can't be managed. So if we can see that this is the situation, we need to start to do something about it. And the thing that we can do is start to look at our Black-owned banks. Here are some of the things that Black-owned banks can and should offer to the Black community. We need personal loans. We need business funding. And we need quality. This day and age, with this technology, we should be able to get instant decision on personal loan applications. Business loans are a little bit more complex. I understand that. So no more than 1 to 3 days to get an approval on a business loan. We should be approving credit scores as low as 550 because of the things that have happened to the Black community and to most Blacks in general. If documentation is required, it should be enough documentation to make a decision without scaring people away, because you want them to come to the bank with a wagon full of paperwork to show that they have some ability to repay a loan. And if it's someone who is a constant borrower, our business community, for an example, they should be able to get low interest rates on their loans, because you know they're coming back to borrow from you again. To give you an idea of what Black-owned banks and Black-owned credit unions are like in the United States, again, we see most of them are in the eastern part of the United States. We see in the red dots, those are bank locations. We saw that from a previous slide. The yellow dots are credit unions, and we're going to talk about that a little bit more in a minute or so. The green dots represent one Black-owned bank, United Bank, up in Boston, Massachusetts, and they started a strategy of being able to have online banking. So you see that there is a green dot in every state in the United States because they had the potential of doing banking, and I believe they have a small number of Black clients or customers in every state in the United States, even though they don't have bank buildings or branches out in those Midwestern to Western areas of the United States. Some of the largest banks, or the ones that are existing, we see in this list. I'm not going to go through the whole list, but I will point out for you that, and this is in alphabetical order, One United Bank is the bank that's in Boston, Massachusetts, that has an internet strategy, a virtual strategy. Some of the other banks, they're in predominantly African-American communities. I would recommend that you find an African-American bank or Black-owned bank that is in your community. The more deposits we put in those banks, the more loans they can make to Black business owners. The more loans they make to Black business owners, the more Black business owners can hire people. The more people they hire, the better our unemployment numbers look. So part of our strategy has to be, we need to look at helping ourselves. We can't expect other people to come in and help. When I talk about that, here's the reason why. I spoke a little earlier. If we look at the chart here, the average dollar that goes into a community, how long it circulates in that community before it leaves that community. In an Asian community, it's almost a full month before a dollar that comes into their community leaves their community. Now, for a lot of you, there's a lot of Chinese restaurants, and I'm not knocking them, in our communities. So that's money that's going into their businesses. Where do you think that money is going at the end of the business day? The Jewish communities, it's almost 3 weeks that a dollar will circulate within their communities before that dollar leaves their communities. In predominantly white communities, it's about 2.5 weeks that a dollar will come in and circulate within that community before it leaves that community. Unfortunately, in African American communities, the amount of time that it takes for a dollar to come into the community, circulate throughout the community, and leave the community is not even a full day. 6 hours. I'll repeat that. 6 hours before a dollar comes in and leaves our community. And the problem with that is because we don't have enough Black-owned businesses that we're doing business to keep those dollars circulating in our communities. We don't have enough Black-owned banks to keep those dollars circulating in our communities. Let's stop and think about it for a minute. If your child is looking for a summer job, we had to go to the government to create jobs for them. Why could they not have gone to a Black-owned business to get a summer job so that they could get started on their employment career? It's because in most cases, there weren't enough Black-owned businesses to go around. There weren't enough Black-owned businesses to go around because a dollar leaves our community 6 hours after it comes into our community. It's spent at a Chinese food market. It's spent at an Italian delicatessen or Jewish delicatessen. It is spent at somebody else's business who does not live in our community. So when they close up shop at the end of the day, they're taking those dollars with them to their communities. I didn't mean to dwell on that so long, but that was one of the things that brought this whole think tank together. But businesses started recognizing that. In the Wall Street Journal, they talk about it. There are only 18 Black-owned banks in the United States. That's half of what existed a decade ago. So there's a movement to help those Black-owned businesses survive. We need to be able to expand the number of Black-owned banks we have. Fortune magazine says the same thing, making Black banks matter. And believe it or not, in the tech industry, they recognize that, and a lot of tech companies are actually depositing money in Black-owned banks. This all stemmed from George Floyd, and a lot of businesses, white businesses, started saying, well, how can we do something to make things better? And what a lot of them started doing is they were making deposits in Black-owned banks in the expectation that Black-owned banks would lend to Black businesses and Black homeowners, and that would be a way that they inject money into the Black community. But we can't rely on outside businesses and the tech industry to be the ones to help us. We have to start helping ourselves. So if we look at banking today, everything that's in purple, these are new strategies and new capabilities that banking has. Everything that's in white are existing capabilities that banks have had for some time now. When we look at this layout, we can come up with a number of different ways that we can do banking in our communities. So for an example, we look at the fact that there used to be a building in our communities that we can go to. There were tellers there. You go inside the building, you deposit your money, you write your checks, you go in and apply for a loan. And most of the major banks have pulled out of our community. What's it going to cost to build a new bank building in the average community? That could be anywhere between $1 to $4 million. I'll be honest with you, most of the major banks are not going to make that investment in our communities. Okay, so here's an alternative. Real estate partnering arrangements. We see it in a lot of our communities, especially if you live out in the suburbs. You go into a grocery store and there's a bank outlet inside of the grocery store. In the Washington, D.C. area, Capital One has started building coffee shops. So they're selling coffee just like Starbucks, but there's banking there also. So you can go in there, hang out, have your coffee, have client meetings, whatever the case is, and you've got people that can take care of your banking needs right there on the spot. Now, wouldn't it be wonderful if we went into Black-owned businesses, Black-owned stores, and there was a Black-owned bank who took up some of the space there that we can go into and that we can do our banking and take care of our banking needs right there in our community. It would help the Black-owned business, it would help the Black-owned bank, and it would help the Black-owned community. That's one strategy. The other strategy is electronic banking. These days, you don't need to have something where you have a giant safe sitting there that you have to worry about hiring security guards, that you have to worry about, making sure that you safeguard the cash that's sitting inside that bank. The reason why is because you have electronic banking. So you have ways that you can move money back and forth. I love the fact that when I get paid, it's a direct deposit. I don't have to stand in line with a paper check waiting to either cash it or deposit it into my account. Goes in electronically. I can walk into a store and I can use my bank card to make purchases. And if I needed to get cash back, I can do that also. So technology has opened up a bunch of opportunities for us. We look at some of the companies that are out there that can help us with paying things. There's Cash App, there's PayPal, there's Zelle. A lot of companies you can go directly through the internet. I know I had friends that have said that the fact that people are not mailing a lot of checks, that's an issue for them, but that's what it is. And if you look at Killer Mike, who started his operation, it's all online banking. I'm looking at the time and I realize that I'm running very short. Church-run credit unions. Now, that's where you have a church that can decide to open a credit union, not only for its members, but for its community. Okay. And the whole idea is people come in, they deposit their money in the credit union. That money is used to create loans for the members. They can get car loans, they can get home improvement loans, and when the credit union is successful, the members are successful. The reason why is because it's member owned versus the bank that is investor owned. So there are a number of different comparisons that you can make. Credit unions are a lot easier for organizations to open also than it is for a bank to open. So your church can start a credit union. I would advise that if they do so, make sure you have the right professionals that are going to work it. Just because Sister Susie, is tight with a dollar doesn't mean she knows anything about banking. So make sure you have the right people in mind when you do that. A couple of books that I would recommend that you consider. The Color of Money, Black Banks and the Racial Wealth Gap. I just started reading that one. I haven't quite finished it, but very interesting so far. This is not meant to be a shameless plug, but Unlynched. This is by our visionary, LaKesha Womack. I read this book on a plane coming back from a church event, and I was amazed at what she had in there. I would recommend that you pick this book up also. It talks more or less about the mentality of being able to manage your financial situation, much different than what we have been ingrained with. And the last one, for those people that want to know anything about that whole subprime lending bubble that took place back in 2008, I recommend reading The Big Short. That's, I can't even begin to talk about that. But do we have any questions? I know I'm pretty much hitting it right on the mark, if not a minute over. If there are no questions, I want to thank all of you who have come. But if you have any questions, feel free to drop them in the chat. I'll be happy to stick around for a little while and answer any questions that you have. If not, I want to thank you for staying with me for the 5 minutes that you have for a break and allowing me to finish this presentation. And I look forward to seeing you in some of the other sessions starting at 2:45. Thank you very much. Thank you, Carla. And thank you, Levon.